Okay, welcome back to corporate taxation incentive stock option discussions, part two for this part of the lecture. And what we're going to do now is we discuss the basics of stock options in the last video. This is going to go into a little bit more detail as to actually what happens from a tax standpoint when options are exercised or when they're sold, what exactly goes on. And here's the issue. Let's look at it first from the non-qualified side. Ooh, that's nasty. All right, non-qualified. What happens when you're granted non-qualified stock options? And by the way, if you go to work somewhere and you're told we have a non-qualified stock option plan, there's nothing wrong with that. It's still very, very valuable. It just has different taxation qualities. And so this is what happens. When you get the option, there's no tax. So that's still good. No tax event. When you go to exercise the option, you're going to buy the stock at the bargain price. It's going to be worth more than the bargain price. And when that happens, you, the employee, will recognize, and you'll know this from your yay boo sessions in class, you'll recognize a boo, because it'll be ordinary income. The ordinary income will be the difference between the fair market value at the date of exercise versus the exercise price, which is that bargain price. That difference is ordinary income, like compensation. So we'll say compensation. Ordinary income. All right, not the greatest, but still, look what you got out of it. You got to buy the stock when it's worth more than the exercise price. You got a bargain purchase. That's cool. On the employer side, the employer actually gets recognition of the fact that you're recognizing ordinary income, because at this time when the stock option is exercised, the employer takes a payroll deduction for the ordinary income you pick up. So the employer actually gets a ordinary income deduction. And how do they balance this entry? If this is the debit for the expense, the credit is to the newly issued stock, because you just bought stock. So that's an equity account, in case you needed to know. So from the employer standpoint, they don't come out too bad either, because even though they gave away this stock, they get the deduction for the amount of income you pick up. That's what's called, in tax theory, we're looking at symmetry. Someone just picked up ordinary income, and someone just got a deduction. So it balances out. There's a plus that someone's picking up ordinary income and someone's getting a deduction. And it balances out. That's symmetry. It doesn't always happen in tax where there's symmetrical equalizations of fairness, but here the tax law has got it nailed down pretty well. It happens. All right, that's the non-qualified stock option plan. All right, now let's do the following. Let's see. How do we do this? I had this going pretty well up a minute ago. I see why. Okay, there we go. That's why. All right, let's look at the opposite end of the spectrum. We're going to do the qualified stock option plans. Let's get some room on the board here. It's pretty clean. Best erasers, and notice that I have no problem writing on this whiteboard, unlike at the campus, and don't send this recording to any of the administration staff up there when I make this comment of how they don't supply the room with any markers. So don't send them this video or a link to the video. At any rate, back to the drawing board. If we have the qualified stock option, the qualified incentive stock option, there is no tax on getting the option. No tax when you're given the option. So we call that the at the option, or the grant of the option. When you're given an option, you call it being granted an option. No tax there. There's no tax when you exercise. That's really cool. That's what makes it qualified, by the way. Qualified plans have rules that non-qualified plans don't have. Qualified rules have rules of discrimination practices, who can get the incentive stock options, what language has to be used. So if an employer can live with the rules, they will do, or they'll be inclined to do the qualified stock option. But if you're just trying to reward people and you want to reward them the way you want to reward them with these options, and you want the language to be very, very flexible, the way you want those options to read, then you'll go the non-qualified route. And again, there's nothing wrong with that. Of course, the fact that upon exercise there's no tax with a qualified incentive stock option makes that very, very valuable. If you sell, you can sell within two different periods. If you sell according to the rules, and basically we're not going to go into all the details of the rules, but basically if you sell after after 1 year of your exercise, then everything's well, because any gain that you realize from your purchase price at the bargain price versus the fair value when you sell will be capital gain, and that's a yay. If you sell before that, then that'll be ordinary income, and the employer will get the deduction that we learned about before. Here there will be a no deduction for the employer, but there would be one here if it's ordinary income, because it's a non-qualified sale, or it's a I forgot the language, but the sale doesn't count towards getting capital gain. So the basic issue is that if you exercise your options in a qualified plan, your best play would be to wait to sell until after a year. Of course, you run the risk that the stock value could go down, but you're always running a risk with any types of companies that you own stock in, even though it's your own employer's stock, and even though it was given to you and you bought it through some kind of bargain purchase price with these options. There's always some risk. At any rate, that's what happens with the qualified and the non-qualified stock options from a tax standpoint. There's one other issue to talk about with either one of these, and that's what's called Section 83B. Section 83B is an election that allows the employee, upon receiving the options, to recognize the tax as if they exercised. Recognize the tax then. And the advantage of doing that is do it at the value of the stock when you got the option. It's somewhat beyond the scope of this course because this is a business entity course, but Section 83B, basic idea is the election allows for the employee to pay the tax at the date of the grant of the option when the stock value is low. Pay the tax at the option date. You don't have to, but it's an election, and it makes sense if you think the stock is going to go up. Pay the tax at the option date. Makes sense to do if you think the stock's going to go up in value. If the stock actually goes down in value, it could go against you because you've already paid the tax, and maybe you'll never even exercise the stock option. But it's a pretty powerful thing if you believe that the company stock will go up in value. Okay, next on the hit parade then would be let's look at some examples quickly. January 14th. Oh, this goes into temporary, permanent, different. We're not interested in that, so the examples aren't that great here. what we want to do for one other purpose here in terms of explaining the taxation of stock options is we want to take one more look at one other part of it, and that is the following, which we didn't cover before, but now we need to just cover it now. With the qualified stock options, incentive stock option plan, we said no tax upon exercise, and that's true. However, to the extent of the fair market value at the exercise date less the bargain price, the option price, let's write that better, that gain that you don't have to pay tax on is subject to being as an add back. And whenever you hear the word add back, if you paid attention in tax 1, you're already figuring out what it's an add back for, the dreaded alternative minimum tax. It's an add back to alternative minimum tax. That means that you may still wind up having to pay tax on the exercise of a qualified stock option, even though you are not selling it, and even though it's qualified and you don't have any ordinary tax, you may still wind up paying the alternative minimum tax. Which brings up a really, really cool tax court case, and this is how we'll end. We'll go through this tax court case. This is really cool because it shows you the trouble when alternative minimum tax occurs when you exercise a qualified option. And let's see what happened here. This is a true case. Jeffrey Chow, listed here at the bottom. This is the citation for the case if you want to read it. He was employed by Granite Systems in 1996. He was given 80,000 stock options to buy 80,000 shares of stock. Exercise price 5 cents. That's the type of bargain price these things often come at, 5 cents a share. Then Cisco Systems bought Granite, and so they were converted to Cisco incentive stock options, and they grew to approximately this number. In the year 2000, he exercised when the fair market value, and listen to this, look at the bargain element he got here. He exercised some of his shares when Cisco shares had a value of $64.69. So it was worth, and remember, it didn't cost him anything to get this. He was just granted these options because he was a good employee. So this was now worth almost $7 million. Jeffrey was a rich man. So he exercised, and he didn't have to pay tax on the exercise, according to the way we learned. And he held on to the stock to get the capital gains treatment. See what it says there? He held on to the stock to get the preferential capital gains treatment, which we learned many, many times in class is really a nice rate. By the end of 2000, the value of the stock had decreased to $40 per share from the $60. So now the value of the shares of stocks that he was holding was only worth $4.2 million. I feel real sorry for Jeffrey on that. Although, if it were me, I'd be happy to have $4 million in the bank. That would be cool. In April 2001, the bad guy came to Jeffrey's life, to his tax preparer. Oops. Jeffrey's tax preparer informed him that he owed almost $2 million in tax due to the AMT, because the value, the 6.9 value, was an add back to AMT. So his alternative minimum tax went up by 6.9, and that was the value. Well, it was actually 6.9 minus the 5 cents, because remember, it's the fair market value minus the exercise price. So he had some basis, but for all intents and purposes, 5 cents a share, he was paying He was paying that was a lot of add back to AMT, almost the whole amount. Now, the kicker here is the following: he's going to owe almost $2 million of tax here because he exercised under a qualified plan. And get this, when he was told he had to pay $1.9 million, almost $2 million, by that time the Cisco stock had gone down in value again from the initial $64.69 that it had been worth to, and let me show it to you so you can see it. The stock went down to $17.64 per share, and now his shares were only worth $1.879. So he couldn't even sell the shares to pay the tax. In fact, he did sell the shares in the actual case. He sold the shares here at this number to get the cash to pay the tax, but he was short about $100,000. And so he had to come out of pocket, or he had to borrow. I think he borrowed the money to pay the rest of the tax. Or no, I don't think he even paid the tax. He took the whole thing to tax court, and his argument, which was, I don't know who the lawyer was, but the lawyer should be ashamed of themselves of taking a case disputing the liability based on the reasonableness of the tax. It is what the tax court says. It is what it is. The law is what it is. We're not here to. The tax court can't judge the reasonableness of the law. The tax court can only judge if the law is being applied properly. So Jeffrey lost the case. Now what he should have done. Well, I guess he tried to do it. He tried to argue that he shouldn't have to pay the tax because he can't afford it, but he could afford it. He was able to sell the stock that he had and pay the tax off, which is what he did. He couldn't maybe pay the rest of the tax liability where he was short almost $100,000. But Jeffrey's problems are a classic case of not thinking to ask. This is the lesson to be learned. Jeffrey's problems are a classic case of always ask your accountant before you do something, because the accountant would have told him, ask your CPA, that's what we'll say. Ask your CPA before you do it, because the CPA would have told him that you could have an AMT problem, and if the stock goes down in value, this is what happens. All right, we're going to stop there. We'll pick up when we come back. Go to another topic.